Good afternoon, ladies and gentlemen, and welcome to the HOSTMORE PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet company dashboard, and we'll notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, I'm sure the company will be most grateful. And I'd now like to hand over to Alan Clark, CFO, and Robert Cook, CEO from HOSTMORE. Good afternoon.
Good afternoon, thank you. So my name is Robert Cook. I'm the CEO of HOSTMORE Group. I joined the group as CEO of Fridays in December of 19. And previous to that, I was CEO of Virgin Active for 4.5 years, 3 years as CEO of De Vere Hotels, and 8 years as CEO of and the growth story behind Malmaison and Hotel de Van coming together from 2004 to 2012. I spent my life in hospitality, born and bred in the hotel industry, and have carved a great time for myself throughout in the industry, and really enjoying the time here, relighting the flame of Fridays and creating HOSTMORE. I'll pass you over to Alan to introduce himself.
Thanks, Robert. So Alan Clark, I started with Fridays as the Chief Financial Officer. Joined Fridays a couple of weeks before the pandemic actually struck. So it was probably an opportune time, as Robert reminds me, because it was a time for us to sort of use it. My past experience has largely been hospitality as well. I've had the pleasure of working both internationally and in the UK. My most recent experience prior to joining TGI Fridays was with D&D Restaurants, which some of you may be familiar with, is a group of independently branded restaurants. And at that base, if I could hand you back to Robert.
Thank you. So we're going to take you through the presentation. We're going to do this at quite decent speed. So those who wish to reference that, it's on our website. And any questions, obviously, we'll keep till the end. So I can pass you on to Alan to talk you through the key information on the demerger.
Thank you, Robert. So the key items that we'd just like to highlight. Sorry, just getting it. The key items that we wanted to highlight was that we are a demerger from Electra, who is our parent company. The process for it was that we did not raise any funds as part of the process. It was just a issuance of shares in specie, dependent upon the shareholders of record at the date. 3 shares were issued for each Electra share at that time. So at this present stage, we have a total of approximately just over 126 million shares listed on the London Stock Exchange. We are listed on the main board as well, and we trade under the ticker MORE, as you can see at the bottom.
So thank you. So I'd like to take you through some of the key highlights of the story thus far. So HOSTMORE is the new home for Fridays, a leading branded casual dining offering with unique market position, and also our new sophisticated city-based cocktail bar and restaurant proposition, which I'll take you through a little later in the presentation, which is called 63rd and First. Coming out of the pandemic, we've seen strong supply and demand dynamic with a scope for selective consolidation. We have a refreshed strategy to create an integrated omni-channel offering and part of our digitalization, and that is well underway. And the transformation has adopted the leading edge technology to support the change, namely with our CRM, with Salesforce, with our new table tablet called Tabletop, and also centralizing our reservation system, Res Diary, into one central hub where we deal with all the reservations, inbound and outbound communication to our guests in a central reservation center. We've seen that we have a diverse and well-balanced estate across location types, regions, and metropolitan hubs. During the pandemic, we demonstrated successful cost management geared to future growth, offering an attractive financial profile, focused on cash generation and, in fact, cash preservation during the lockdown, and enhanced profitability for the go forward. The management has had a real aligned and a robust and relevant ESG strategy centered around nutrition and energy, And what many of you will not know is that when I took over the helm at Fridays in December 19, there was a need then, as the management team had gone with my previous incumbent, to create a new highly experienced management team, transforming the business and accelerating performance. So we move now to the next page, and we give you an overview of HOSTMORE. So the key facts and figures are that in 2019, we had sales of 214 million and an EBITDA of 25.6 million over 87 sites, and we employed 3,175 people. On the other side of our new sidecar is 63rd and First, delivering a quality food sharing plate concept, very cocktail-led, in a way of refinding that lapsed user that we discovered from the research that I'll come on to in a second, had gone to from Fridays. The key highlights for 21 were the launch of 63rd and First, our 4D implementation, our move into delivery, which we weren't in before the pandemic, and straight to 72 restaurants through the two aggregators of Just Eat and Deliveroo, and the like-for-like growth versus 19 of 11% and 2.8% outperformance of the market. On the bottom of the page there, we talk about Fridays shaping a new future. So as I mentioned, a new management team was brought in with the remit from Electra to rebuild the business. Extensive customer research was done between the June period of me resigning from Virgin and joining Fridays in the December, where we employed Oyster Catchers, the consumer research company, who conducted a survey to gather insight on the Fridays consumer, the brand, the product, and its values. From that, 3 core pillars were identified. Conclusions were from that distilled into 3 objectives. That was the business required an injection of quality, both in the raw material, particularly around food, and on the drink side, and particularly cocktails. Relevance, applying to the same 2 things, and also a simplification of the product offering, because simply it was too wide-reaching and not executed to the plume that it should have been for our guests. There was a brand refresh also undertaken, a complete overhaul of the brand identity, recrafting the iconic brand, and getting it fit for the digital transformation and for it to be more agile in the digital and particularly in the social media channels. And not unlike many other jurisdictions in the world, the TGI was dropped from Fridays in the UK, like it is in other parts of the world, to just simply be named as Fridays, with the F icon working and sweating hard for us and showing an agile nature on the social media platforms as we go forward. And then lastly, the 4D strategy, which was to invigorate the group. And that really was the catalyst for that was during lockdown. How could our stores, our well-loved and respected brand, operate outside the 4 walls of the stores in the delivery space, in the digital to home space, and potentially in the drive space? As we move on to through this presentation, we looked at the diverse and balanced estate across location types and regions. So on the right-hand side there, you see the map of the UK. And we have good presence across the UK with stores as far up in the north in Aberdeen to the south coast, and in fact also into the Channel Islands. So a good mix of stores and a great platform to build more stores upon. And you'll see in a later slide the opportunity there with white space, and our penetration versus competitor presents us with an opportunity. On the left-hand side, you'll see our mix of footfall locations, from retail park and shopping centre being the predominant, to city centre 15%, standalone 14%, and stadia, which were very small in only 3%. But glad to see stadia reopening now as we come forward. The standalone sites, I should mention as well, stood us in great stead during the first lockdown, because we were able then to, in our own car parks, do a click and collect service. And through the May to July period, July 6th, when the business reopened, we achieved £6 million of the revenue and £2 million of EBITDA in that cohort alone. If I take you on to the slide I just referred to, and in the large market poised to benefit from post-COVID recovery, as you can see in the bottom right-hand slide, on the right-hand side of the slide, 554 closures coming from only 18 of the top casual dining restaurants has been reported, and continual reporting again about a month ago that CGA said 1,000 restaurants more had closed since that first figure. And then again yesterday, another report coming out saying that 31% of insolvencies had happened since July in the restaurant space alone, showing that it's been a tough time for our sector, but I think we've come out of it stronger and have shown great resilience within that. Pent-up demand has been exceptionally high, in the period from May through to 19th of May this year through to the beginning of September, and the schools going back, was particularly noted as very strong for us. And in particular, and continues to this day, is the spend per head moving from the £17.33 that we enjoyed in 19 to over £20 in the last 21 weeks as an average in the period since we reopened. If I can move on to the next slide, if I may. So in this slide here, we demonstrated a couple of things. First of all, the large bubble in the center is where we see ourselves sitting, and very much at the top end of that, with an aspiration to move into, from a price point of view, into the more casual dining, premium casual dining space. And that strong spend per head and differentiated experience is certainly where we're heading for, and the spend I've already alluded to. If you look at the left-hand side and you see the total size of the market of 10.7 billion in 2019, and then the impressive figure from a Friday's point of view of the average sales per week of being 49,000 versus our comp set of 25,000, or the casual dining peer being 25,000, that's really down to our scale and efficiency. Our average size of restaurant is around 6,400 square feet, which is approximately 1,200 square feet larger than our competitor. And with that, we're able to turn and burn tables at peak. Peak being for us a Friday evening, Saturday during the day, Saturday evening, and Sunday all day. And we really see ourselves performing well at that peak, which demonstrates it helps us achieve that 49,000 against the 25,000 of our comp set. On the next page, and strong brand loyalty positioning to be a winner in the marketplace where competition is struggling. Interesting graph here where you see the only three stores that have not, businesses that have not seen stores close, ourselves, Wagamama and Nando's. But also that if you look at the far right bottom slide, where we've only got 34% penetration against Nando's of 94% and 82% and 72% of Wagamama, it shows that there's a huge opportunity for us to penetrate the marketplace, which we see as a real gain for us in the future. We also talk about brand loyalty on this page, and that is referring to our loyalty app, where we now have 773,000 users. And in that cohort, we are able to talk to our guests on a regular basis about the time of day and the day of week that they use our stores. We don't discount in Fridays like the rest. Only 3% of our total sales are in discounting. And therefore, we see the opportunity for our brand loyalty, and that's 773,000 users. We talk to them about the redemption of their points and potentially doubling points in areas, in times of the day and days of the week outside peak. So we're dynamically managing our diaries through the investment that I mentioned earlier in our remodeling our reservations from a central point to from a store point of view to a central point. This probably is the most important slide on the go forward. So this is what we call our 4D strategy. So dine in, that is our strength, that is our core, and will remain our core. Fridays at its center, but also our new brand, 63rd and First. And I'm pleased to say that on Thursday night this week, we open our 63rd and First in Harrogate, having opened Glasgow and having opened Cobham to date. The being for 63rd and First came out of that consumer research we did with oyster catchers, saying that we had lost our way in the cocktail world, and there was a big opportunity for us to re-engage with lapsed users and existing users who wanted to get out of the family environment in our type of store environment to go into a more sophisticated and fundamentally a Fridays for grown-ups. So the opportunity was there to do that, but also the dislocation in the marketplace and the distressed inventory that we've been afforded to have a look at and acquire over the last year and a half has been where we've really taken the charge. Interestingly, all of our 5 sites secured have came from Italian businesses. Carluccio's, we bought 2 sites from there. We bought 1 site from Gusto, 1 site from Ask Italian, and we've just completed on a site in Cambridge from Strada. These sites are around 4,000 square feet. And again, the interesting thing here is that we're able to convert these at about £650,000 rather than the 1.4 to 1.8 million, depending on the square footage that we convert on Fridays. We have, in fact, of one of the Carluccio stores we converted Lincoln into a Friday store, which has been very successful, hit its targets already, and only opened in May. And that was a 4,200 square foot restaurant that was 630,000 to convert. The days of us as a management team, looking at that 1.4 to 1.8 million conversion of store is long gone, partly because of the opportunity that it presents itself with distressed inventory that's becoming available and made available to us. The second D of our 4D strategy is Fridays Delivered. That is the which I mentioned earlier around our click and collect service and our partnership with the aggregators Just Eat and Deliveroo. We're up to 71 of our restaurants in both are supplied by Just Eat and Deliveroo. The rest of our restaurants don't have that coverage yet, and it's a meaningful business for us. We actually are investing in our new stores in dedicated delivery satellite kitchen within the main kitchen, repurposing the back of house in order to get the delivery product better in the box and out to the guest than we probably have been doing. But I think delivery, the shoot up in delivery as a result of the pandemic, it was a needs must basis, and therefore we had a great business with that. It still maintains to be about 5 to 6% of our overall business, and it's something that we know is here to stay and want to invest in, and particularly when we repurpose and rebuild when we build new stores. The third part of the strategy was digital. How could we take Fridays to home? How could we get it into the living rooms and the kitchens of the homes, particularly during lockdown again? But, you know, with the success we had with our cocktail range, our butcher's packs to home, and our DIY meal kits, led us on to asking the US, where we have the franchise agreement from, if we could have the retail franchise agreement for alcohol in the UK, which we've now secured. So in late Q4 and going into next year, we'll be announcing and launching an online range of branded cocktails, beers, and wines that will be able to be bought through the likes of Amazon, drinksupermarket.com, and the likes of Majestic. Now, to date, we've only been able to do that through our own website, but the winning of this new franchise agreement with the US enables us to do that. And then lastly, the D is Drive. For Drive, do not read Drive Through. This is Fridays and Go. This is a QSR that we're creating that you would drive to. It's a longer term opportunity, but we are testing and trialing a store in Scotland in the first quarter. We'll open at the end of the first quarter in 2022. Will be our first Fridays and Go. So a grab and go, priced slightly above the larger operators, but in line with the likes of the Leons and the Five Guys of this world, serving very authentic Fridays food, just in a different format in a packaged state. A lot of technology to get the food right, but also to get the ordering and paying right for the guest. And we see that being a test site for us, because we have been made approaches and actually signed an NDA with one of the largest motorway service operators to look at coming into their new experience, given the move from filling your car with gas, with electricity, with diesel and petrol, to moving to electricity, which obviously has a longer fill time and therefore more dwell time at station, and therefore a more experiential requirement for the guest. So we're very excited about Fridays and Go, and we see it's a real extension to the dine-in, both in the high street, but also in that motorway service environment. And I should add at this point, it's also the area that we were going to be looking to develop quite hard for Fridays, given the white space that we talked about in our brand penetration only being at 34%. Whether you spend your money in dine-in, delivery, digital, or drive, our loyalty program that I referred to is you can earn points in that. The references you earn your stripes, and that will then give us exclusive closed user group offers, time of day offers, day of week offers, and redemption offers, as well as attracting the celebration, i.e. birthday type environment to the business. That will really work very hard for us. We see that as it being hopefully to grow to over 1 million users by the midpoint of next year. And to give you an idea, when we came here, it was about 520,000 users, and we're now up to 773 and growing. So we see this is a real good conduit to our loyal guest, but also a way of dynamically working and helping our diary management as we go forward. And then lastly on that page, the HOSTMORE, a development platform. HOSTMORE was created by its name, to host more. Yes, Fridays will be at our centre, and the growth of 63rd and First is important, but we also see ourselves, given our cash position and our strength of business and our covenant strength as being an opportunity for us to potentially add new franchise territories within the Fridays organization, additional franchises, or really where our focus is on is the acquisition of undercapitalized fledgling brands that are smart disrupting the space, that are light in capital and require some help with that. And we see ourselves coming into that space. It's an interesting time at the moment. We have been, in terms of our development of Fridays, Fridays has a development obligation from the US franchisee to open 8 sites by the end of 24. 8 further sites. We've already opened one of the obligated sites, and we are well on the way to do that with the 4 sites that we're going to open next year. They've been very attractive because we have attracted, because our covenant strength and the way we've behaved through the pandemic with our landlords in terms of rent payments, and Alan will come on and talk about that, is that we've been given very advantageous and attractive terms with some 7-figure capital contributions to open new stores for Fridays in the foreseeable future for next year, and therefore we see that as being a moment in time for us to grab those opportunities. We also believe that the next moment in time will be at the end of the rent moratorium, where some maybe have not dealt with rent in the way we have and not in the position of strength that we are in, that we see there'll be more distressed asset, both in single site opportunities, but also in portfolio opportunities at the end of that happening. At that point, I'll take a breath and pass you over to Alan to take you through some of the stats that we've enjoyed over the last 12 to 18 months.
Thanks, Robert. So this slide is setting out our performance against the market. What we're using in terms of the benchmarking is the CGA Business Tracker. It comprises some 35 casual dining groups, some 2,500 stores, to give you an idea of the scale. On the left-hand side, it's really the reflection of trading post the first reopening. This is obviously from 6th of July, as Robert had made mention to. We were very quick out of the blocks, as he'd said, and I think this gave us an opportunity relative to the competition. So I think we gained a little bit of market share during those first couple of weeks, and hopefully we've retained those guests. The second month, obviously, as we moved into Eat Out to Help Out, yes, everybody was largely open again, or certainly the largest store groups. But what is pleasing here is that you can see that the gap between ourselves and the actual competition maintained its level, the gap, and that was very rewarding. Into the month of September, we ran our own promotion. We didn't do sort of a direct cash discount, but what we offered was a focus in terms of growing the app users. As Robert had mentioned, this is a very important part for us as we go forward. And during the month of September, we picked up some 44,000 new users, which we've now very pleased to see are still active with us. And then as you lead through towards the end of November, you can see through the tiering system and the introduction of regional restrictions, we continue to maintain a small gap against the competition. On the right-hand side is really the more recent trading period. In the month of April, obviously the restaurant sector was able to reopen again. We underperformed for the first month, and this is because we don't traditionally have a lot of outdoor dining space. So we recognize this, and we've tried to cure this by entering discussions with the many landlords that we have. And what we're pleased to say is that we've picked up the equivalent of some 1,300 additional seating capacity, which our landlords have given to us at no increased cost, which we can use going forward. And this is the equivalent of 4 completely new stores in terms of capacity. So we see that as a future benefit as we move forward. The intention of this is obviously to use it for the shoulder seasons and then obviously the summer period next year. Through the course of the year, you can see that we've sort of continued with a slight gap against the competition working a little bit harder as we go. On this slide, you can see the first the first deck in terms of our trading performance historically. All the numbers which are being presented here are in the older traditional FRS presentation format. And the couple of things that I really want to highlight on this page include the following. In the top right-hand corner, the revenues of 215 million FY19. What I really want to highlight here is that the revenue generation itself is fairly equitable across the 4 quarters of the year. And this is from a low of 24% of the annual revenue in the lowest period to a high of 27%. The 27% is the last quarter 4, because of the traditional Christmas. But what I am pleased to say is that we're not overly dependent on events or specific periods of the year in order to generate our revenue. The second thing to highlight here is the EBITDA. Historically through the FY18 and 19 periods, you can see an EBITDA in the region of about £25 million. We think that this is a good, strong base from which to develop the business. I think on the go forward, with some of the work that we've done through the pandemic period, we're optimistic to improve upon this. But it does certainly provide an indication of the cash which is being generated, which will provide sufficient funding to meet both the organic growth that Robert has made reference to earlier, and then also the possibility and the probability of investor returns by way of dividends once we've assessed the opportunities in the lead up to the end of the moratorium period at the end of Q1. The bottom right-hand corner, it's really our net debt profile. This is bank debt less cash. And what I'm pleased to see is that regardless of the pandemic, we've managed that downwards. Yes, the FY20 number does include some deferrals in terms of the VAT, which HMRC allowed us to pay back at a later date. And it also included an element of landlords, but which I'm very pleased to say has substantially diminished. And I'll show you some further detail in that in a moment. What I'd like to finally on this slide just highlight is that through the pandemic period, we did not get or receive any financial support from either parent or third party or lending banks, apart from traditional sort of covenant waivers, which you would expect under the circumstances. On the next page, or the slide which is being presented now, it's sort of the current trading position since the reopening. What I'd like to highlight here is that consistently over the period of time, we've outperformed our FY19 like-for-likes. There is a balance between the two. The covers, in terms of the volume, the guests coming back, is slightly lower than what we've traditionally done in FY19, but this has been more than offset by the improvement in terms of the spend per head. And why I think it's important here is because sort of the analysis that we've looked at is that a lot of sort of the cover or the demand shortfall that I make reference to seems to be focused more towards the earlier part of the week and in the more elderly demographic. So you would expect sort of, as we sort of explained it, the grandparents who may be slightly more cautious to come out just at this moment in time. What I am pleased to, however, highlight is that the spend per head is showing that significant improvement. And this has not been driven by inflating prices unnecessarily. What we've done instead is we've tried to improve the guest experience by working on the quality aspects, which Robert had highlighted. And I think that puts us in a very strong position in terms of price elasticity in case with sort of the conversations ongoing about inflation to allow us to sort of counter that risk. What I have highlighted here is the net debt, but adjusted to include the COVID-related accruals. And you can see that over the trading period has continued to reduce from the end of last year. So once again, sort of good working capital management, partly down to also some good trading since the reopening that's taken place. Finally, sort of in terms of the costs, which is a very important part in terms of the current sort of conversations that are taking place, there are three component elements that we would like to highlight here. In terms of commodity prices, that is the food and the drink which is going into the preparation of the meal which is served. Yes, there is a lot of discussion taking place. Yes, there is a number of suppliers who are seeking increases, but what I can say is in most instances we've been able to mitigate either by way of further discussions with those suppliers. A lot of our suppliers have been with us for extended periods of time, so the relationship is very strong. Or we've also gone to sort of menu engineering, whereby we've adjusted our menus where we found it not possible to accept such a price, or we've considered the alternative of seeking alternate providers. So our sort of forecast in terms of immediate price inflation at this moment in time is nowhere near what some of the sort of indications that are in the marketplace. The second area to highlight is payroll. It's a very significant part for our business because obviously we invest significantly in our staff. And we are aware that government has announced the increase in the national minimum wage. That does have an impact on us. But how we've tried to mitigate that is through three different ways. One is through the period of the pandemic, we went back and we renegotiated the contracts with our employees such that it has a higher level of variability there too. And this allows us to flex the payroll to a greater degree. The second element is we've put in very good quality data systems, workforce management systems, which allow the general managers now on a daily dynamic and more dynamic basis to be able to see what is actually coming through in terms of demand and therefore being able to roster more efficiently. And then thirdly, we've also introduced a new concept of efficiency, whereby we've looked past the more traditional view of looking at payroll, which is a percentage of revenue, and we've looked into sort of more different factors such as which are more efficiency based, and we're working on a new metric called a covers per labor hour, which highlights and distinguishes just how well you're actually utilizing the number of your payroll in terms of human capital. So we think a lot of those actions will go a long way to mitigate in the short to medium term. The third area, which is quite significant as well and is much more recent, is the relative increases in terms of utilities. Here, I'm very pleased to say that in September last year, we entered into new contracts with suppliers for both our gas and our electric. And what that's resulted in is using the FY19 volumes for both gas and electric, we hedged our pricing forward. So by way of example, our gas pricing using FY19 volumes is actually hedged in terms of its pricing through until December 23. Our electric pricing, once again using the FY19 volumes as a benchmark, we've hedged 50% through until the end, 100% through until the end of March 22, 50% through until the end of March 23, and 25% through until the end of December 23. So our view is that certainly in the short to medium term, we've substantially mitigated that risk. To give some idea of the scale of the benefit that's come as a result of that hedging, using the wholesale price of approximately 3 weeks ago, it's in the region of about £7.5 million worth of additional costs, which we've been fortunate enough to avoid. The last thing I'd like to highlight on this page is the fact that we're obviously aware that the VAT rate is expected to increase again. We did make a small price adjustment to take into consideration the first amendment, and then we will look at once again a small price adjustment at the end of March next year. However, what we will do is obviously take into account both feedback from customers in terms of how they're reacting and also what our competitors are doing to make sure that we remain relevant. This slide sets forth the sort of forward-looking numbers in terms of our expectations. I'm not going to go through every single one, but really just to highlight that our sort of jump-off point in terms of revenue going forward. You would have seen from the earlier slide, the FY19 delivered £215 million worth of revenue. Our expectation, when you include the annualization of the new stores that were opened in FY19, plus what has happened more recently in terms of the price adjustments and the spend per head, we believe that the £235 million run rate for indoor gross sales is achievable. The second thing I'd like to highlight here is that the EBITDA margin in FY19, you'll see it sitting at around about just sub 12%. Our view is that through some of the actions that we've taken during the course of the pandemic, and I make mention to the variability of the payroll and the work that's been done in terms of the landlords and utilities, these are all things which, when aggregated, we believe should allow us to improve upon that percentage as we move forward. In terms of the interest, what I'd like to highlight here is an opportunity that has come to the fore as a result of the good trading of the past 6 months. And what it is that we have changed in July, we actually went back to our banks in advance of the demerger, the lending banks, and we renegotiated our banking facilities. We therefore changed the structure of the lending banks facilities from a term loan of £65 million to one of £40 million, plus an RCF, a revolving credit facility of £25 million. The benefit of that is that through the cash generation of the past couple of months, we've been in the position to pay down the RCF, whereby at this moment in time, it is 100% undrawn. And this provides us with the firepower in order to consider opportunities in the short to medium term. A little slightly further down the page, just wanted to highlight the CapEx. Our view is that the estate is in a relatively good shape. A lot of the stores, as Robert has highlighted previously, have been opened in the last 5 years. So we have a good core base of stores that are in a fairly good condition. So our view in terms of maintenance CapEx in the short to medium term is in the region of 1.25% to 1.75%. And also then Robert had highlighted sort of the cost of the new stores that we enter into at sort of the 750 to 1250. That's a bit of a range, because we take into account obviously the different dynamic of each store that we may wish to actually open. With that, if I could hand you back to Robert.
Thanks, Alan. If I can just really summarise the overall investment highlights we discussed. I think what we've hopefully demonstrated today that we've got a robust platform for HOSTMORE to grow, both for Fridays, for 63rd and First and for that fledgling brand opportunity. I think we demonstrated we are in a strong cash position in terms of that, but also a strong cash position in terms of cash generation. We're well down the way of our digital transformation. Our CRM is totally embedded, and we bought the best in class there with Salesforce. So we've got a single customer view now. So no matter how as a customer you deal with us or how you interact with us, we corral it all to one place, whether that's through social, web, form, or text. We've invested heavily in central reservations, so we're more efficient in terms of our table management, our yield, our capacity management, and considerations such things as dwell time, and are now looking at day of week and time of day to try and fill those gaps by releasing more tables and giving more inventory back to peak. And then lastly, the most important thing probably is from an efficiency point of view, and from a technology advancement point of view, is our new tabletop tablet that we're trialing, that we'll have rolled out by the end of next year across all stores, where you can order and pay at table. And in turn, we, through artificial intelligence and machine learning, we will be able to write our menus of the future, given that that's what you, the guest, the customer, has been asking for, but also influence you to upsell when you're prompted that people are buying certain dishes with certain side dishes with certain main courses. That prompt comes up electronically, and a bit of gamification on that makes fun at table more enduring. And also it means that our teams, the payroll model becomes more efficient, but also the more times to deal with the customer facing aspects rather than just simply plate carrying. So with all that, the great state of our state that our estate is in, the good balance in that estate, our demonstration of good cost management and resilience, and particularly the way we've handled landlords through the recession, through the lockdown, we feel that we're in a very strong position to take this business and grow this business significantly forward in the future. So at that point, I would open the floor to any questions that there may be.
That's great, Robert. Alan, thank you so much for updating investors. I've now brought your camera back up. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Robert and Alan take a review of those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we will send you an email when that's ready for your review. Finally, I'd like to remind you that your feedback is important to the company, and immediately after this presentation's ended, we'll redirect you in order that you can provide the company with your views and expectations. Robert, Alan, we did receive a number of questions from investors before today's presentation. And of course, as you're just seeing now, there's been a significant number from investors throughout today's live meeting. So thank you firstly to everybody for submitting those questions. But perhaps I could start off with the first question, if I may, which reads as follows. I believe the business expects 7 to 8 net new stores each year for the next few years. Is this correct? And what percentage of them do you expect will be Fridays versus new brands like 63rd and First?
Well, that is correct. The immediate year, 22, we will see 5 new Friday stores opening. We have a development obligation with the US for Fridays. That is to open 9 new stores by the end of 24, and that will be reviewed in 24 for the next session. That was a renegotiation we did as a result of the demerger. Prior to the demerger, the development agreement read 2 things that were of significant change. One was we had to open 5 stores per year. And in the interest of rebuilding balance sheet and so on and so forth, the US re-entered that part of it to say 9 stores over the next 3 years, which give us some breathing space. But as I've already described, opportunities and capital contributions from landlords has accelerated that. And the second thing was that the original 60 stores that Electra bought were not able to be disposed of until the end of their lease. Now we've changed that we can dispose of stores. So we have 3 stores that we have going to be leaving the business that are underperforming and have been loss making. So the tail gets tidied up at the same time. So to answer the question, yes, to open 5 new stores next year is what Friday is going to do. We are under the guys that we are going to open by the end of next year. Open and acquire 10 63rd and First. Bear in mind there are 3 open and 1 already secured. So we've looked for a further 6 there. And the opportunity on the go forward for Fridays is obviously to continue growing that. So I would say for every 7 Fridays or every 5 Fridays we open a Fridays, we'll be opening 2 to 3 63rd and 1st. Fridays is our lifeblood. We see 63rd and 1st being a brand of getting up to about 20, 25 stores, because you want to get it into the right locations first, and then we'll take a strategic review on that at that point. And then in terms of other opportunities, as Alan's articulated, we're in a strong cash position, and I think I've said already that we'll wait until the moratorium comes to an end at the end of March. That will also herald the end of the VAT, and I think that will put some business under pressure. So therefore, we see real opportunity at that point to acquire at the right price, and potentially either on single assets or on small portfolios that we may want to take that portfolio and continue it as is, because we've been excited about portfolio, or convert that portfolio into Fridays or 63rd and 1st. But the real ambition there is to find a third brand that is what I would call a smart disruptor, and really making a stir in the industry that requires capital.
That's great. Thank you very much indeed. Turning to the next pre-submitted question, what is the current amount of interest-bearing debt, and what is the most the business plans to take in order to support its expansion plans?
In terms of that, I've highlighted the bank lending facility that we have refinanced. So the maximum at this moment in time is, the quantum of debt at this stage is 65 million, of which 25 million is undrawn. Our ambition in the short term is not necessarily to go back and seek additional debt. What we've tried to do over the course of the last couple of months is conserve cash and prepare ourselves so that we can move very swiftly should opportunities come to the fore. So our immediate ambition is not to take on new debt. There is maybe slightly more recently, I've become sensitive to the fact that Bank of England is now starting to become under pressure in terms of increasing interest rates. So I am aware of that, but that in its own right will obviously be considered as part of an investment opportunity analysis should opportunities come our way. But there's no intention at this moment in time to increase the lending debt.
That's great. Thank you, Alan. And then the final pre-submitted question, what will the dividend policy be?
The dividend policy is very much driven by a short to medium term view of opportunities that may come our way in the marketplace. So what our preference would be is for us to retain cash. Let's have a look, explore the opportunities that come up through the course of Q1 and maybe into Q2 next year. But at the same time, we're not going to sit with idle cash on our balance sheet. And there is an undertaking and certainly an internal understanding that we will be commencing a payment of a dividend in the medium to longer term. And that our ambition is for that to be something that we can not only introduce, but also maintain.
That's great. Thank you very much indeed, Alan. Perhaps I could ask you guys just to open up that Q&A tab on the right-hand side of your screen. And if I could, you've got a significant amount of questions, and obviously I'm just mindful of time, but if I could just hand back to you and read out those questions where obviously we haven't perhaps touched on in the presentation, or where you feel that you can give some extra clarity. If I could ask you to read out the question and perhaps even who it's from, that'd be great.
Yeah, so it's a question from Mark L. Do you see yourselves as purely a UK operation looking for TGIF and other brand opportunities here, or is there a prospect of expanding to continental Europe with the TGIF brand? Very interesting and very good question. So we've got first of all, we're the biggest, we're the largest franchisee that the US have outside the US. So we're a big player for them. We've forged a fantastic relationship since I came on board. In fact, I was meant to be there this week, but just with the pandemic and so on and so forth, have decided to go over there in January. But I think there is absolute opportunity, and it's for them to want us to do this as well. But there's absolute opportunity for us to look at where they are not in continental Europe, given that we've got a very solid back office here now, and I'm refer to reservations and all that platform we now have, financial platform, supply chain platform, as well as reservations. I think there is a possibility that we would consider taking Fridays, or taking another territory on in Europe, but using the UK as its fundamentally its back office to make the commercials stack up correctly. So that's something that may be considered in the short term. Okay, I've got another question here from Paul S. Why could you not create your own format rather than open another franchise brand. Look, I think we understand franchising. We like franchising, and we've been here 35 years doing it. I haven't been here 35 years doing it, but the business has. So it is a good model, and I think we're very happy with the Fridays setup and the relationship we have, and it's quite a territory type franchise. In other words, you can do what's right for your territory within it. It's not too straitjacketed. So there's the finding the franchise of that ilk would be the first thing I would say if we would look outside other franchises. But I also think with one big franchise, there's an opportunity to look at a non-franchise model to sit within HOSTMORE. And to be honest with you, that's really where our focus would be in the short term.
I'm going to respond to a question from Tim K. I've just watched many slides on how great Fridays is compared to competition, yet it trades at about half the same enterprise value to EBITDA multiple to the same competition. Why? I guess, Tim, you're absolutely right. I think where we are sitting at this moment in terms of share performance, I think is below the true value of the business. I think there are a couple of reasons why it has contributed to that. We are aware that Electra was a trust, and there are a number of investors who unfortunately cannot remain invested direct to the consumer, which is now through the demerger we have now become. So there is a requirement in terms of their mandates whereby they may have to exit their investment. What I'm very pleased to say, however, is that amongst the top 10 investors that we have within the business, all of them have retained their positions. So what we're talking about is the possibility of investors sort of in slightly smaller but still holding a significant number of shares who feel that they now need to exit. My sense at this moment in time is there's a little bit of an overhang. Obviously, as part of a demerger, we don't get the benefit of discovery pricing in terms of working out what is the best price to list at. And secondly, there's also no green shoe in terms of affording the opportunity for us to stabilize the price. So I think the current sort of volatility that you have is linked more to the clearing out of this one larger investor and maybe a couple of smaller investors who don't want to remain directly invested with us. But my sense is that the value proposition should correct itself as we move forward.
Okay, I'll answer a question from Alan C. You attended a presentation last week, competitive hours, with highlighting chronic shortages of chefs and admitted that they could not even open the kitchen in a few stores, only in the midweek evenings. Are we seeing some of the pressures? There's no doubt we are seeing pressures. And by the way, the chefing community has been under pressure for the last 20 years, so it's not a new thing. It is certainly it's certainly more extensive at the moment, but we are not in a position that we can't open stores because of that. We took a view that as we came out of the pandemic and we knew we had to rehire, we had over 53,000 applications for 1,200 roles that we had available. And a lot of that was back of house. It is the hardest area to recruit, so we decided that we would review the salaries and hourly rates of back of house. We've also put in a stay bonus for them to stay over the Christmas period, and I think many others have done that. But equally, we've linked up with the likes of the Institute of Hospitality and worked with them and ourselves on a chef program of development, certified, accredited and with certification. So therefore, there's a meaningful career in chefing. I think, like we did in our hotel world, we need to move to 4 days on, 4 days off for chefs, a highly pressurized environment. So I think culmination of many things has made our problem probably not as heightened as others, but it is difficult. And I'd be lying if I said we didn't have our challenges or had our challenges, but you just have to react swiftly to these. And now we're in a good place in terms of our chef community with very few vacancies in the business. And that's ditto for general management and front of house. And, Fridays benefits from a fantastic trunk system. The gratuity bank is strong in Fridays, and that is a big attraction, obviously. And, we know that on a good Saturday night, Friday night in some of our stores, our restaurant teams can be, well, I was quoted last week from one of our larger stores at a restaurant, waitress was walking away with £28.50 an hour. So that does set us apart from the rest, and it does help enormously. Nikhil, you've come up with a very good question around what will the UK regulation around displaying calories of menu items involve, and what does the anticipated effect on Fridays? Well, first of all, I welcome it. I think it's very important. I think the state of nutrition in the UK at the moment or around the world is not where it should be, and therefore I think transparency on letting people know what the calorie count on a dish is really, really important. We've done a lot of work around reducing calorie content. For example, our fry products have all gone into a fryer now with an oil with a reduction in saturated fat from 29 grams to 8. So we've invested in olive oil in the cooking oil for that. We've reduced sugar, particularly around our JD glaze, and we have reduced salt in many dishes. So I applaud the government's view. I think it will be for the consumer to give the real view of what they think when they know what a calorie count is on various dishes, and it may change behaviour. But I welcome it. I think as a restaurateur or a restaurant business, we've got a moral obligation to look after people's health, and I think this is a great step forward. So I'm fully on it. Greg W has asked a question: do you profit from the sale of Friday's products in Iceland stores in the UK? Short answer: we do not. It's a US agreement. They've got a food franchise agreement, retail franchise agreement with Iceland, as they have with Tesco, and that's why I went after the beverage one, which we've now secured for ourselves. So it could be, if we prove successful on the online channels, that you could see our own Friday's branded cocktail, beer, prosecco, or wine in can in supermarket shelves in the future. That certainly would be a great result for us if we were able to achieve that. It's certainly an aspiration, but we don't profit from Fridays in Iceland. Henry G is asked me the question: is 63rd and First under franchise agreement with the US, or are there no franchise fees paid on that brand? It is under franchise with the US, and I'll tell you for why. I've been asked this question a couple of times. One of the obligations of our franchise agreement is that the Fridays team have to give 100% commitment to Fridays, and therefore we were not able to do a second brand at that time. We are now, obviously, we can now look at that under HOSTMORE, and that's why we're talking about the fledgling brands. But to be honest with you, the opportunity to, when it came that we got to get the opportunity to develop a new brand, and the US allowed us to use the 63rd and First name, the franchise agreement states that in the first year there's a moratorium on any fees. Second year it's 2%, 3%, and year 3 and 4% in year 4. So it allows us time to build that brand, and then there is an open negotiation to whether we benefit from that brand if it was taken by the US into any other territories. So that's the reason, and the articulating the reason behind why we are a franchise agreement on that certain brand at the moment. Any future brands we do under HOSTMORE with a dedicated team, that if we bought a business with a team and we intentionally would keep that team, would not be under that obligation.
Can I respond to a question from Mark I? What is the sales mix by day part and week parts, and what is the demographic mix of the customer? In terms of the sales mix, it is very much weighted towards the Friday through to Sunday. It's in the region of approximately 60 to 70% of our revenue is generated on the Fridays through to Sunday period. This is very important that it's identified, because as Robert has sort of indicated earlier, with our investment in the data and the analytics, this is the end by growing the app users. This is an area where we see the opportunity to move those customers into the shoulder periods or different times of the week through either incentivization or dynamic pricing, which will allow us to sell additional capacity during those traditionally busy periods anyway. In terms of the demographic, we have two very large elements which are sort of in the region of sort of 15% each, which is the 20 to 29-year-old group and the 30 to 39-year-old group. I think this is important from the perspective that part of the underlying motivation for the creation of 63rd and First was to address that. And Robert has made mention previously about the lapsed users, and these are the people that we're attracting back to the Friday brand, but via the 63rd and First, in terms of the uniqueness of that.
I'll answer a question here from Alex L around 63rd and First, so a little bit more detail on 63rd and First. So I think I've described why we created it, and I've described the financial metrics and terms behind this. Just on the last bit on the financials, we're managing to negotiate at the moment rents of about £18 per square foot for 63rd and First versus legacy estate, i.e. Old Fridays, at £36 a square foot. So there is an opportunity for us to pick up 4,000 square foot properties at that sort of level. The brand itself, named after the two roads that met, where Fridays was created in 1965, and this is about two roads meeting in terms of cocktails and food. Cocktails being the number one part of our business. It's a 70-30 business, so it's opposite to what you would expect in most casual dining experiences. So we are 70% beverage, 30% food. Our target sites are by no fault, they are deliberately around university towns and affluent cities, fundamentally where we've traded before in both Malmaison and Hotel de Van, where we saw good food businesses and good beverage businesses, particularly in Hotel de Van, being wine-led. So this is a cocktail bar with sharing plate food, which is sort of eclectic in taste, but with an American street food theme. So you're getting corn dogs and savory donuts and all this sort of stuff. Very, very cool American food with great cocktails made with the best premium spirits. And then in terms of margins, we see these where Fridays is in the high 70s, these in the low 70s. And we're at 3 stores. Harrogate opens on Thursday night, with Glasgow and Cobham already open, Cambridge secured, Edinburgh almost over the line, and Oxford, Bristol and Bath on our pipeline of target cities that we are either in negotiating or looking for sites at the moment. So that's 63rd and First, and it's also a great place for it's a great place for as a sort of, it came out of the research that I said, as a place for the grown-ups of Fridays to go to, who used to enjoy Fridays but are probably past that flamboyance and fun and flair that happens on Fridays all the time, which is the experience that everyone loves, but just for that more sophisticated environment. And so far so good. The first two have opened well. They've hit their revenue targets, and we've honed and tweaked a little bit as we've gone along, but we feel we've got the right model now that we've now got crystallized in Glasgow, and that will replicate itself through Harrogate next week and then into Cambridge and Edinburgh in the future. Ian G's asked the question about what actions are undertaken to mitigate the effects of the skill shortages and shortages in labour. Well, I think I've sort of covered that with the chef point, but that is also in front of house and management. And obviously we've put in for the first time a really smart objective-led incentive scheme, which will be paid out to the general management community, particularly the management community and the support centre, on a successful year of trading. And then, of course, for that cohort, we've just announced the opportunity to join in the share scheme that we've launched as a result of becoming a PLC. So that is another retention tool, but also attraction tool as well. So that's what I would say on that, along with what I said earlier about the chef situation. It's not all about the hourly rate. It's about conditions. It's about work-life balance. It's around training and development and making a career at hospitality, which, in different times, whether it was end of Gulf Wars or in recessions of the 2007 crash, I've been around. Alan was with me in those days, and we did the same thing and built a brand in the hotel sector that developed talent from within, and that's what we're all about. And I think we do that, and our talent stays with us because they like the fun of Fridays, but also the rewards that are now in place as we go forward.
If I can respond to a question from Simon T. Has the PE-funded rollout model mania largely departed the market for more enticing pastures, and is this to your advantage? I think the short term is yes, there are a number of PE houses which have burnt their fingers more recently, certainly through the course of the pandemic, and have needed to undertake restructuring or refinancing of their investments. As to how long they will necessarily stay out, I guess my sense is that they will come shopping again at a moment in time. My sense at the moment is that they are not immediately circling. What they are looking for tends to be people who are sort of looking for extreme opportunities, and these people are making inquiries. What it does do, though, is that, to Robert's earlier point, is it gives us a window opportunity to operate within, whereby we can act almost a bit like a PE house to go out there and seek those opportunities, be they single sites or be they small groups, fledgling groups that are appealing for us to bring in. So the short answer is we're not seeing quite as much activity. We do think that they'll come back. Possibly one thing that helps us is sort of interest rates as we go forward, as to whether they think they can get better returns somewhere else in different sectors. But I would expect them to come back in the medium to longer term.
Thanks, Alan. Just three quick answers to three questions here have come in. I mentioned the moratorium. I'm talking about the rent moratorium and the inability for landlords to come after tenants who haven't paid. I think that is coming to an end of March. And I think when that does happen, that's going to give us quite a lot of opportunity from our point of view, because some people simply will not be able to make their rent obligations for one reason or another. Simon T's also asked a question about 63rd and First, 100% owned by you. Yes, it is. The actual operation is owned by us. We have a franchise agreement with the US, but we've got 100% control of this. We're building it for them, not any other way around. And they've got no say in how we operate or set it up. And then Marco F, you've asked, do you have any an estimate of how many restaurants could be able to open in the UK before reaching saturation point to the long term? I think Fridays can be, given the penetration we have of 34% against the comp set, we could get up to 120 stores quite easily. Whether that's core brand stores and or QSRs, let's see how we test in QSR. If it goes well, I see that being quite a significant business in itself. But we have to test it and make sure we've got all the touch points right for the consumer. But I think to get to 120 stores, and we're at 87 today, in the next 3 to 5 years is very doable for Fridays. There's a lot of white space out there. It doesn't have a Fridays, and it regularly happens that at a weekend I will get emails from people saying, we've traveled 60 miles to Essex tonight, why can't I have one in Southend, please? Or can't I have one in Warrington? Or can't I have one in Peterborough? So there's a big demand. This is a very, very popular brand, global brand that is growing globally. I mean, India, we just signed a master franchise agreement in India. We're up to 24 stores in Taiwan. I spoke to James Sinclair, who runs our Australian business, last week, and he's looking to treble his business. Fridays is on the march, and that's not just in the UK. So I think there's massive opportunity. Yeah.
If I can respond sort of to Mike H in terms of what exposure does management have through equity or options to the business post demerger? In answer to that, Mike, we are very much engaged with this. The senior management team were awarded shares as part of the demerger process. Robert and I both have interests whereby we have to, our interest is locked up for a minimum of a year. So there's a very sort of close relationship there's a very close relationship that we have with wanting the business to perform. On the go forward, in terms of the bonus schemes that have been put in place, these are generally share awards. So once again, they are driven by an alignment with yourselves as shareholders or potential shareholders.
And Beth, I'll just answer one last question from me, and that's your question, because it's a question that's very topical in our business. How are you trying to deal with the average reviews for various restaurants on TripAdvisor and Google? So one of the other reasons that we set up the central res was not just to be an inbound, but also an outbound. And we deal with that on a daily basis. And we have a 48-hour turnaround on all TripAdvisor or any of the aggregated trust pilots or whatever of this world, and our absolute goal is to retrieve that guest who had an average experience, and restore their faith in our brand. And we do that through good dialogue. We do it with interaction that's face to face. We don't do it with standard letters. And we also have got the ability to do e-voucher if we feel that we've let anyone down, and it's all about restoring faith in the brand. And I think we've got so much better at that since we went to that central resource, and it means that they are speaking humanoid to humanoid, which in many customer experience service centres you're not always doing that. So we have live chat, but we actually deal with all TripAdvisor by voice.
Alan, if I may, and Robert, if I may just come in. Obviously, you've taken a lot of questions from investors today. I'm kind of mindful of time and the fact that investor feedback is important to you. Of course, thank you again to the investors for submitting questions today. And of course, if we haven't come across your question and it's appropriate, we'll provide responses after the meeting has ended, and we'll notify you by email when that's ready for everybody's review. Robert, perhaps before I redirect investors to provide you with their thoughts and expectations, I could just hand back to you for a few closing comments to wrap up with.
Yes, thanks very much, and Mark, and thanks for everybody for joining the call today. We really believe in this the brand. It's been we've only arrived in December before the lockdown. It's been a rocky road, but I think the time has been well spent. We put good time into the crisis, used it well. We've turned every stone in the business, and we believe we've got a business not only that's solid but also has got the ability to grow. So we're very excited about the future, and with 63rd and First, alongside that, and the opportunity with our wherewithal to go and do other brands, we think this is a platform for the future, and we're very excited about it. So, yeah, that's all I want to say. Thank you.
Alan, Robert, thank you once again for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued and welcomed by the company. On behalf of the management team of HOSTMORE PLC, we'd like to thank you very much for attending today's presentation. That now concludes today's session. Good afternoon to you all, and thank you once again.